stocks are breaking records. The S&P 500 index is climbing to historic highs, and investors are celebrating. But something is starting to happen beneath the surface. Valuations are at their highest in 5 years, with some companies trading at prices reminiscent of the period before the dot-com bubble burst. And the first warnings are starting to come from Wall Street. A correction may be approaching. Is the rally really so unbeatable, or are we on the verge of a slowdown? We are currently seeing valuations on the stock market that are causing concern. The S&P 500 is trading at a forward PE of around 22 to 23 times, which is significantly above the long-term average of around 18 to 19 times. We last saw similar levels in August 2020 and at the turn of the millennium. In August 2020, after a sharp fall caused by the pandemic, the index's forward PE jumped to 23.6 times. Similarly, in 2000 during the dot-com bubble, the P/E ratio of the S&P 500 index approached 25. In both cases, a sharp decline followed. After 2000, the index fell by about half in 2 years, and between 2020 and 2022, the market experienced several major corrections. You can find out how and why these corrections occurred, and how stocks subsequently recovered from these declines in an article on Valuations, which covers this topic in detail. Experts compare the current situation to market overheating. The S&P 500 index has been breaking records regularly this year, but many analysts warn of a possible consolidation. The market is now somewhat saturated, and a correction in the range of 10 to 15% would not only be possible, but even normal at the beginning of a new growth cycle. This is pointed out by Morgan Stanley's chief equity strategist Mike Wilson. Similarly, Morgan Stanley's Ted Pick highlighted at a recent summit in Hong Kong that investors should welcome a small double-digit correction as a healthy cleansing if it occurs without deep economic shocks. Other leaders such as David Solomon of Goldman Sachs have also mentioned that technology sectors are currently trading at very high multiples. JP Morgan, on the other hand, warns of an increased risk of decline in the coming 12 to 24 months. However, not all companies are pulling the index in the same direction. It is extremely concentrated. The 10 largest companies, mostly tech giants, now account for almost 40% of the S&P 500, thanks to huge growth in valuations supported by AI technologies. These giants trade at an average P/E ratio of around 30, while the remaining 490 companies trade at a multiple of around 20. Those that remain below their fair value and have the potential to catch up with the current giants in the future can be found, along with their fair prices, in the Fair Price Index on Valuations, which experienced investors use to conduct their own thorough stock analyses. Together with the communications sector, the technology sector accounts for a record nearly 45% of the index's market capitalization, which is more than during the dot-com bubble. This means that market sentiment is strongly influenced by a few stocks, the largest ones. As long as they grow, everything is fine. However, when their valuations begin to decline, it can significantly affect the entire index. This skew and enormous growth in profits explains why stock prices have more than doubled in the last 5 years, even though the index's P/E ratio has remained relatively stable. Although the S&P 500 index has climbed from around 3,500 points in August 2020 to nearly 6,900 points today, this is mainly because corporate profits have grown at a rate comparable to the growth in stock prices. Extreme operating margins have been the main driver of profit growth. Now, however, the price of individual stocks is far above the real value of companies. The macroeconomic environment, however, suggests that the situation may change. Inflation in the U.S. is currently around 3%, which is above the Fed's 2% target. However, a number of indicators suggest that the economy is growing at a slightly slower pace. Job creation has slowed this year, and while the unemployment rate remains low, it is rising slightly. Yesterday's ADP report on private sector jobs surprised the economy. In October, the number of jobs in the private sector increased by 42,000. It had been declining in previous months. Valuations Black members have immediate access to this information, giving them a perfect overview. Join now and take advantage of a special offer by clicking on the link in the description. You will receive a 10% discount on membership, and the first 7 days free to try it out. Inflation has risen in recent months and is now at 3%. Consumers have been a little more skeptical in recent months. However, readily available money, low interest rates, has so far kept corporate investment and consumption afloat. Retail sales and consumer card spending continue to grow, albeit at a slower pace. The Chicago Fed reported plus 0.3% real month-on-month retail growth in October, Low-income households are already feeling the pressure. Rising healthcare costs and the possible cancellation of food subsidies threaten to reduce demand. What does this mean for investors? Risky opportunities remain, but it is wise to be cautious. In the short term, we may see a slowdown in market growth or consolidation. It is also quite likely that recent highs will be tested by a decline of several percent. According to Wall Street, a correction of 10 to 15% would be a normal part of the cycle. In the longer term, the ability of corporate earnings to maintain a high growth rate remains a key factor. If margins begin to decline, or economic growth does not exceed stagnation, there could be a more significant correction. Conversely, if corporations continue to grow profits and inflation falls, high valuations could be offset by gradual earnings growth rather than falling prices.